Hi, real estate friends. It's Liz Young with RE/MAX Executive, and welcome to episode 23 of my video series. Now that we're heading towards the end of the year, it's time to start thinking about taxes. And today I have with me Nikki Thorton of the Stell CPA firm. She is an accountant with Stell CPA, and we're going to talk about the capital gains rule and if you have to pay taxes on your house based on how long you own it. So take it away, Nikki.
So the main thing to keep in mind is you do have to have your house 2 of the 5 years. It does have to be a primary residence. If you are single, you're eligible for $250,000, or if you're married filing jointly, it is $500,000. There are certain qualifications. You have to be the owner, and it does have to be the primary residence for at least 2 of the 5 years. And you also cannot have made an election within the last 2. So those are some things to keep in mind, and it cannot be a like-kind exchange. And then if you are a widower, then there is a potential of you being able to do the $500,000. You can't be remarried. It's going to be within your ownership, kind of the same rules in a way, but just keep that in mind as well. Talk to your CPA about that. Now, if you have recently left and had a new job, then you could potentially do a partial election with this situation for a primary residence. It does have to be 50 miles or more, and it has to be from the previous job. Say Atlanta, where you were working, and that's 15 miles, and you're going to another place in Atlanta. That would not qualify. There's also an unemployment where you might be able to take partial sales on it, and there's one more. It is if you have somebody that gets sick in your family. There's also those situations where you have to move, and those are just some exemptions from the 2 to 5 years. So just keep those things in mind. Talk to your CPAs. They definitely know what will benefit you most. And another thing with the calculation for the gain, you'll have your sales price. There are certain expenses that can offset that sales price, and then the basis that you originally bought it, and go ahead and kind of keep track of any improvements that you did for that property as well, because that would be your gain.
Awesome. Well, thank you so much, Nikki. And a lot of my clients are asking because homes have appreciated so much. So many homeowners are sitting on $50,000, $100,000, $150,000 in equity. So keep in mind that there are tax implications depending on how long you've owned the house when you sell. As always, reach out with any questions, and I'll be happy to connect you with Stell CPA firm as well. Bye for now.